The Roth IRA is an estate planning tool, my friend. Vanguard just published this a few days back about using the Roth for estate planning. I want to talk about this because this is, man, I love it. Someone should just write a book on the value of the Roth. Who would that be? Well, it'd be your old buddy Josh here at Heritage Wealth Planning. So don't forget my book, The Tax Bomb in Your Retirement Accounts, and how the Roth helps you avoid it. All right, so there's a Dateline, March 13th, 2019 from the advisors.vanguard.com. I can't remember how I signed. I'm an advisor for sure, but I don't remember how I signed up. I just remember, I remember. So maybe you can or cannot, but I'll put a link in the show notes nonetheless. All right, converting client assets to a Roth IRA rather than keeping in the traditional IRA can lead to significant greater wealth accumulation over time. Hey, look at that. Yes, sign up, get your insights straight delivered to your box. The tax-exempt benefit to heirs of a Roth is significantly important for those subject to estate tax. And don't really care so much about that because the vast majority of us regular folks are not. But we got to worry about what? The IRD, income with respect to decedent, not the estate tax for the vast majority of us. IRD is a big one. The estate tax would also have to pay an income tax if they inherited a traditional IRA, not just the estate, but the heirs as well. All right, the first in a three-part series in using Roth IRAs to maximize wealth transfers. That's what I'm talking about, Vanguard. I'm hoping they read my book. Many clients hold substantial assets in tax-deferred accounts, such as traditional IRAs or workplace retirement plans. But depending on those goals, clients might want to think about converting some or all of those assets to a Roth. Discussions around conversions most commonly focus on retirement planning and expectations for current and future tax rates. However, clients may not understand that the Roth IRAs can also serve as a vehicle for effective estate planning wealth transfer goals. When an advisor is dealing with a bevy of estate planning concerns on behalf of a client, the potential in Roth accounts can be overlooked, says Garrett Hebron over at the Vanguard Wealth Planning Research. The long-term tax advantage may be there, and even if that's not always clear, the prospects of integrating the Roth for heirs can prove worthwhile. When clients convert from an IRA to a Roth, they prepay the income taxes for beneficiaries. That's exactly what's happening. You are basically saying, I will pay the tax for you, little Joni, so you don't have to pay him in the future, but there's more than that. Additionally, and if a state is large enough to be subject to the federal estate tax, the conversion means their heirs will not also have to pay income tax on the distributions in which to pay the estate tax. Both the growth within and the qualified distributions from a Roth account, of course, are not subject to an income tax, making a Roth a valuable structure for estate planning. From wealth transfer perspective, Roth IRAs have two advantages over traditional IRAs. They do not require RMDs, required minimum distributions. The amounts that would be paid out in RMDs and subject to income tax in a traditional IRA can continue to grow in the Roth tax-free. This could result in even a greater account balance when the Roth IRA is ultimately transferred to heirs. Second, qualified Roth distributions are also tax exempt. No income tax is due when withdrawals are taken. And these features can substantially increase after-tax wealth for beneficiaries. How clients pay the taxes due at conversion can also have a significant impact. Roth conversions may either be tax exclusive or tax inclusive. All right, so we're going to talk about this. If clients pay the taxes with assets outside the IRA, the conversion is tax exclusive. I'm converting $100,000. It's going to cost me $24,000. I have $24,000 in my checking account for which to pay the taxes. All right, that's tax exclusive. I'm converting $100,000. It's going to cost me $24,000. My net value after conversion is $76,000 because $24,000 is taken off the top for my IRA. That's tax inclusive. That makes sense? Now, there are mechanisms on which way it works better, but we'll just use those two scenarios for the time being. Tax exclusive, tax inclusive. It's often a better strategy for tax exclusivity because you're increasing the after-tax value of the Roth. So you have $24,000 that's coming from a checking account. My Roth account now is $100,000 as opposed to my Roth being $76,000. I hope that makes sense. At the end of the day, it's not going to be huge. I mean, I don't want to say it's, robbing Peter to pay Paul. It's not like that. It kind of is, but remember that $24,000 that's sitting in a checking account. If it's a dead asset, i.e., it's not doing anything for you. It's not drawing any income for you anyway. But even if we're doing something, presumably you're going to have taxes on the capital gains, qualified dividends, interest income, or whatnot. So at least the Roth is tax-free. Tax-free is always better than tax deferred. or taxable, I should say. Consider a hypothetical 65-year-old client with a taxable account balance of $24,000 and a traditional IRA of $100,000. I just literally just said that. I mean, I read this, but I haven't read it since 2 days ago, so it's weird how that's still in my brain. And a 40-year-old non-spouse beneficiary. In the following three scenarios, the account owner and beneficiary are both in the 24% bracket. And the beneficiary inherits the IRA in the taxable account 20 years after each scenario begins. All right, so we got mom, we got son. Son's 40 years old. Mom is 65 years old. Mom's got $100,000 in a traditional IRA, $24,000 in a checking account, and she's in a 24% tax bracket. The figure below shows the combined after-tax liquidation of an IRA and a taxable account over time for the scenarios. For simplicity, we assume that no estate taxes are paid. Okay, so scenario one, we're not using a Roth. The account owner reinvests all income and dividends in both accounts. She begins taking RMDs from the traditional IRA at age 70 and reinvest the RMDs into the after-tax proceeds into her taxable account. Upon inheriting the IRA, the beneficiary begins taking RMDs according to his life expectancy and reinvests them net of taxes into the taxable account. All right, so basically we got an IRA, $100,000, $24,000. We're taking RMDs from the IRA, dumping the after-tax account, and they're both in the 24% tax bracket. I don't know about like that. I mean, we'll see what they show us. Scenario two, using Roth and paying the taxes from the Roth. At the end of the day, we're going to leave with $76,000 in the Roth because it costs $24,000 in taxes, in which it's coming directly from the Roth. So that'll be tax inclusive. So the Roth is now $76,000. Use scenario three, we're using the Roth, but we're paying the taxes from the $24,000 account, and that $24,000 account is now wiped out, and now we just have $100,000 in the Roth. All right. As the figures below show, converting to a Roth can lead to greater after-tax wealth being passed to the client's beneficiaries. This is especially true if the taxes on the conversion are paid with funds outside the Roth, tax exclusive. Converting to a Roth initially reduces total wealth by the amount of the income tax paid. However, because RMDs are not required during the account owner's lifetime, the balance of the Roth may be drawn down more slowly than it would have in a traditional IRA. So they're saying basically we've got the three scenarios. There's mom and there's son. All right, so we got traditional IRA. After 20 years, when the son inherits it, is worth $322,000. After another 10 years, we'll just say he dies, it's worth $5,000. All right, so that makes sense. So basically, we haven't done anything. We got $24,000 after-tax account. We got $100,000 in an IRA for Ms. Jane. She starts taking her RMDs at 70, so putting into the after-tax account. When the time Bobby inherits it, is worth $322,000 net of taxes. By the time he dies, it's worth, and that's in 30 years, is worth $545,000. Tax inclusive Roth is still better. It's worth $332,000 when Bobby inherits it, and is worth $579,000 when he dies. And then tax exclusive Roth is worth $339,000 and $602,000 when the time he dies. So significantly more beneficial to Bobby in order to inherit the Roth solely without the taxable account. Let's see here what we're saying. Amounts shown are after-tax liquidation value of the accounts at the end of each year assumes a 6% annual rate of return on a 50-50 stock-to-bond portfolio with all income and dividends reinvested. Portfolio returns consist of 3%, 3.3% from capital gains, and 2% from income, 1% from dividends, which is consistent with the historical average of the breakdown of a 50-50 portfolio. Distributions from the traditional IRA and income received within the tax, I don't like that. Distributions within the traditional IRA are taxed at a rate of 24%, but income received from the taxable portfolio is taxed at 24%. Okay, income, that's good. No, right, good. Dividends and capital gains, the taxable portfolio are taxed at 15%. Okay, good. All right, good job, Vanguard. I didn't know if they'd see that. Assumes the portfolio is rebalanced annually with a tax advantage account and or using portfolio cash. Okay. All right, good. So they did see that. 24% tax bracket. Yeah, that's about spot on. I was thinking, would any of it be subject to no capital gain or distribute or qualified dividend? No, it would be taxable. She's in a 24% tax bracket. Yeah, so ordinary income on income, 50% of capital gains. Man, right on. Freaking Vanguard. Awesome. Other estate planning advantages, potentially passing greater wealth on to beneficiaries. A Roth may also provide two other important estate planning techniques. Elimination of double taxation. If an estate is large enough to incur the estate tax, the beneficiaries must pay those taxes on all assets beyond the exemption amount, including the tax-deferred assets such as a traditional IRA. They must also pay income tax on any withdrawals from these accounts in which to pay the taxes, which would result in double taxation. Generally, it is more advantageous to pass on assets that do not have embedded income tax liabilities. Vanguard. Generally, it is better to pass on assets that do not have embedded income tax liabilities, such as Roth IRA or taxable assets. Interesting. Who's been saying that? Your old buddy Josh. We don't want to pass on embedded income tax liability to our heirs. Reduction of the estate through income tax on the conversion. All right, so anytime you're doing a conversion, reducing the estate, which means the estate has less opportunity to grow because there's less money in there because you pay the tax on it. So that's, I do like that quite a bit, actually. It's not so big of a deal anymore. It used to be, and it depends on what you state. Man, I still have videos on state by states, what states have a state tax. I will do that this week, I promise. All right, so anyway, that's it. I'm a big fan of this. I'll put this in the show notes. Let's see, they got continue to read. Let's read the next story in the series. All right, well, the next story is a Roth conversion to give clients' heirs tax flexibility. All right, sweet, man. So these guys are, they're breathing my air. That's for sure. I love it. All right, this one's dated March 13th as well. So we'll go into that one next. So stay tuned. Don't forget to subscribe down below. I'll put a link in the show notes for you here. I think you'll get a lot out of this article. How a Roth IRA can help with estate planning. I could not agree more. Vanguard's, does it again. Good stuff, Vanguard. So we'll see you next time. Thanks now.